for joining with me on this program today. I know today is a big day because your company is going to merge with Marshall Wace. Can you tell us why you merged with Marshall Wace and what are the benefits bring to your company?
Well, I've known Marshall Wace for over 10 years. They're an old friend of ours, and they've known us for a long time. We've known them for a long time. And, you know, I think we came to this from very different origins, but the merger made sense for both of us. On our side, we were struggling a little bit with the change in investment environment. Our funds today are long-only funds, and as such, we were suffering, you know, with the pullback in the markets. We figured that we needed better trading ability, better risk control tools, better portfolio construction systems, and also better systems to figure out how the market was positioned at any one time. All these things that Marshall Wace has, and probably they have some of the best systems in the world today for all of these. On their side, Marshall Wace had already developed a very successful franchise here in Asia with their Asia Tops fund run by Des Anderson. And they were looking to expand further into Asia with just Asian money managers. You know, knowing each other well, we were discussing both of our difficulties and our problem, and we just thought that maybe merging would bring all of our strengths together and build something pretty strong.
After the merger, you are going to be the CEO of this new joint venture. Can you tell us what are your big plans?
Absolutely. We have three big plans. First and foremost, we have to work on our side at GaveKal on learning how to use all of Marshall Wace's tools so that our existing shareholders in the fund will benefit, will be the first beneficiaries of this merger. That's our first goal. Our second goal, in September, we're launching a Japanese long-short equity fund. And you know, our main aim there is obviously to get that up and ready. The fund is already trading with partners' money, and but to go out, tell the world about it, and obviously raise money for it. And then the third step, the third goal of this JV is to go out and hire more people here in Hong Kong to build our strength, get more analysts, get more portfolio managers, so that down the road we can launch more Asian products, more Asian equity products.
Well, your company is known for your independent research business line. Will that merger affect your research business?
No, I think the JV does not affect our research business. Research stays completely independent and completely separate. And on Marshall Wace's side, the JV does not affect their TOPS business, which is, again, a great franchise that they have. For our research, I think it's actually, this JV will allow our research staff to refocus on being a pure research organization, firstly. Build a Chinese wall between research and money management, since now we will be in two separate offices between the research team and the money management team. And then finally, I think it will also, you know, the new responsibilities on the money management side will hopefully allow me to have a better understanding at any one time at how the market is positioned, and then convey that message onto the research team.
Well, now I'd like to turn this question about yourself. You start a very interesting business line as doing independent research report. Can you tell us why did you come into this business?
It was a bit by luck, really. I was an equity research analyst at Paribas, a French investment bank, and my father had retired. This was in the late 90s. He'd created a research firm, then transformed it into a money management firm, sold it to Alliance Capital, and he was retired. And after about 6 months of him being retired, my mom called me up and said, "You have to get your father out of the house. He's driving me crazy." Having a retired husband is more husband and less money. It's the worst of both worlds. And so he and I started talking about potentially doing a research firm, since that's what we both knew how to do. Now, you know, you also have to put yourself back. This was the late 90s when any kind of business plan could work, and you felt like, oh, maybe we try it and see how it goes. So that's what we did, and very quickly we were joined by an old friend of ours called Anatol Koletsky, hence the Kal in our name, GaveKal. And Anatol used to be editor, assistant editor at the FT and at the Times in London, so he comes from a journalist background such as you, and spent a lot of time interviewing politicians, policymakers, central bankers, so had a lot of contacts there. So we thought, well, if on the one hand we look at the markets and we get one message, and if on the other Anatole talks to politicians and gets the same message, then we can feel twice as strong about something. And that's how we launched, and very quick, and we were lucky enough to get a few clients here and there, and so that it took off. In fact, and this is another funny story, Paul Marshall was our second ever client from Marshall Wace, the chairman of Marshall Wace. And when I went to see Paul to sell him the research, he told me, I'll buy it, but doing independent research is a terrible business. It's very hard to make money. And so, if you want to try it for a few years, do it. But I think if it doesn't work in a few years, you can come work for me. So I did it. It worked, and I still come going to Marshall Wace to work for him.
Mm-hmm. But what do you do if you recommend something in a research report, but finally you find actually things goes completely wrongly?
That happens all the time. I think you can't do research without getting it wrong. And this, I think, is at the core difference in our businesses is that when you're an analyst, you're paid to forecast. And when you're going to do a forecast, you're always going to get it wrong sometimes. When you're a money manager, you're paid to adapt. So every day you come into the office and you think, okay, what's changed and how does that affect my portfolio? So it's two very different skill sets, two very different mentalities. So what happens when we get it wrong? Well, I think when we get it wrong, what our clients expect of us is to look at ourselves in the mirror, look at our mistakes and say, why did we make this mistake? And at the end of each year, we write a piece called What We Got Wrong in 2007 or in 2006, which, could be the size of War and Peace each year, because if we wanted it to be, because there's always a lot of things we get wrong. And what we try to do is analyze, obviously find our mistakes, analyze them, and understand them. And I think, clients are decently forgiving of your mistakes if it looks like you're learning from them, if it looks like you're not repeating the same mistake over and over again.
Mm-hmm. But then your company offers independent research report, but at the same time you also offer some fund product for clients. Yeah. How can you prevent the conflict of interest?
It's obviously, I think this is a very important question. We prevent conflict from interest in several ways. First, we have two separate teams, a money management team and a research team. And now these two teams are even going to be separated into different offices. One office in the IFC for the money management, one office in Central Plaza for the research. So that's the first way. The second way is that we never write on individual stocks. Our research is always very macro-oriented. We try to identify themes, try to identify some macro trends, and maybe talk about currencies, interest rates, that kind of things. Meanwhile, on the money management side, we buy stocks. We'll go out and we'll buy Li & Fung. We'll go out and we'll buy HSBC or Samsung Electronics. So it's different businesses. And I think by not talking about stocks, we prevent a lot of these conflicts of interest.
What tips do you want to give to investors?
I'm always very reluctant to give tips. I think most investment books you read always say never take a tip and never give one. Always try to do your own research. But having said that, I think I'll make it a very broad tip. Right now we're living in, of course, very uncertain times, and the visibility as to the economic outlook has dropped dramatically. In such times, I think it makes sense to have as diversified a portfolio as you can. So not to be too concentrated in Hong Kong equities or in Chinese equities. Try to broaden it out, and this may mean buying Japanese equities or buying US equities. This in these days of very low visibility, very low macro certainties, just keep very diversified.
Thank you very much for joining our program
Absolutely,
today.
my pleasure, Enoch. Anytime.
Thank you.
Thank you very much.